They say currencies don't fall in a single night, they fall slowly, quietly, and then suddenly all at once. And that's exactly the story behind the Indian Rupee right now. What looks like just another number on a screen, 88, 89, 90 per dollar, actually hides a much deeper truth. A truth most people never hear because it doesn't show up in the headlines. But today, you're going to see the whole picture, not just the surface. Welcome back to MoneyPilot, where we break down global money moves in simple, honest language so you can understand what's really happening behind the scenes. Let's take off. The Indian Rupee didn't collapse overnight. It weakened silently for months, like a rope being pulled from both ends. One side pulling was the US dollar, growing stronger and heavier with every Federal Reserve announcement. And the other side was India's external pressures, high import bills, rising oil prices, foreign investors exiting the market, and global uncertainty squeezing emerging economies. But the story gets deeper. For the average person in India, the rupee falling feels like things are just getting more expensive. But to understand why this really happened, you need to look at the invisible forces in the background. And the biggest one is the US dollar index. When the dollar strengthens globally, every other currency in the world feels the pressure, but emerging markets feel it the most. India is no exception. In late 2024 and through 2025, the dollar has been on a powerful streak. High US interest rates kept money flowing into American bonds and out of countries like India, and that alone pushed the rupee down. But here's the twist: India didn't just sit there and watch. The RBI, India's central bank, has been fighting tooth and nail to slow down the fall. Every time the rupee approached dangerous levels, the RBI stepped in by selling dollars from its reserves. Imagine a bridge about to collapse, and the central bank is holding it up with both hands, weakened, but still standing. That's been the story of the rupee for the last several months. But even the strongest hands get tired. India's import bill exploded as oil prices climbed. Every barrel of oil is paid for in dollars, so when oil rises, India needs more dollars. More demand for dollars means more pressure on the rupee. And here's the painful truth: India imports around 85% of its crude needs. That means the country is nearly always chasing dollars, no matter what the global market looks like. Then came the foreign investors, the big players. When global markets get shaky, investors run to safety. They pull money out of emerging economies and pour it back into the US, and when they withdraw, they convert rupees into dollars, causing even more downward pressure. It's like draining water from a bucket where the hole keeps getting bigger. But the most important question is, why now? Why has the rupee reached some of its weakest levels in history? Because this moment is different. India isn't struggling alone, this is a global currency storm. The euro has weakened. The yen fell to its lowest level in decades. Even the Chinese yuan saw unprecedented pressure. The difference is that India still needs more dollars than most countries because of its massive import dependence, rising development spending, and huge demand for goods like crude, gold, and electronic components. For years, India balanced its currency declines with rapid economic growth. As long as the economy grew faster than the rupee fell, the story felt stable. But in the last few quarters, that balance has shifted. Growth slowed. Exports weakened. And once earnings from exports fall, a country earns fewer dollars, making the rupee even more vulnerable. Now here's where the story becomes uncomfortable, the part nobody wants to talk about. The Indian rupee has been falling for decades. Not because India is weak, but because the global economic architecture rewards countries that print the world's reserve currency. The US prints dollars. India doesn't. And as long as the dollar is king, every emerging country will always be playing catch-up. But that doesn't mean the rupee has no chance. There is one thing that can save it, and it's already happening quietly. The RBI is actively building a digital payment economy, reducing demand for physical dollars, diversifying trade partners, pushing for rupee settlements, and signing currency swap agreements globally. These long-term steps don't show up in headlines, but they help protect the economy from big shocks. Still, none of that changes the short-term truth. Right now, the rupee is sitting at a critical point. One wrong global move, another oil spike, another geopolitical escalation, another aggressive Fed announcement, and the rupee could break past previous levels. At the same time, one major positive shift, such as rate cuts in the US, strong FDI inflows, or a boost in exports, could stabilize the rupee again. So, where does this leave India? It leaves the country in a fight. A fight to protect its currency, its economic stability, and the purchasing power of its people. The falling rupee isn't a failure, it's a reflection of the global financial reality. Every country is being tested. India is just navigating the storm with more pressure on its shoulders. And for anyone watching the USD/INR exchange rate today, remember this: currencies rise and fall, but what matters is the nation's ability to adapt. India has one of the strongest consumer markets, one of the fastest growing digital economies, and one of the most active central banks in the world. The rupee may be weak now, but the story is far from over. If you found today's breakdown helpful and want more clear, no-nonsense finance stories, make sure to keep flying with MoneyPilot. Because here, we don't just report the news, we decode it. Thanks for watching. I'll see you in the next one.